Hello, I'm Lee, and this is video number 4 in my series on advanced topics in credit spreads. And on this video, we're going to focus on how to find profitable credit spreads using a screener. So first of all, let's talk about the keys to having profitable credit spreads. First, there's a high probability trade, and second, there's a good profit to loss ratio. You see, for example, if we had an 80% probability of profit, that means that we have a 20% probability of loss. So if our profit to loss ratio is greater than 20%, you have a mathematical edge, a statistical advantage on that trade. So I'll give you another example. Say we're tossing a coin and you have a 50% chance that it's heads and a 50% chance that it's tails. If you can make more than you lose, say you win $2 when it's heads and you lose $1 when it's tails, now you have a mathematical edge in your favor. We use these principles to search for credit spreads that are mathematically to your advantage. So the best way that I found to do that is to use a screener. Thinkorswim has a screener built into it, and there's several web pages out there like optionistics.com, barchart.com, marketchameleon.com, and then I made my own credit scanner using a TD Ameritrade API, and I'm going to show you the details of all of these. First of all, here is the TD Ameritrade Thinkorswim screener that you can use. It's called Spread Hacker, and you can put in some parameters and do a search for spreads that meet your criteria. But I found that even though Thinkorswim is a great platform and TD Ameritrade is a great brokerage, they just don't have the features with the scanner that I can use to really find what I'm looking for. You can't do Iron Condors, and there's a lot of other features that are missing. The next one is this Optionistics. Optionistics charges $40 a month, and they have a bunch of screeners built in, covered calls, spreads, straddles, everything else. It's pretty good, and if you don't mind spending $40 a month, it has most of the features that you could want. I did find that it was missing a few features that I actually want, so I didn't want to use this one either. Barchart.com has what they call advanced groupings. You can do covered calls and bull call spreads and bear call spreads and things like that. But again, it didn't have a lot of features. It can't do Iron Condors, and it still costs $30 a month. So I didn't like it. I decided not to use it. Market Chameleon is very good. It has butterflies and Iron Condors and spreads and puts and all kinds of things like straddles, but this one is $70 a month, and it's still missing these really nuanced features that I want for my own credit spread scanner. So I ended up making my own. Here's my ugly little credit spread scanner. It doesn't do much. It only searches for Iron Condors, bull put spreads, and bear call spreads, but it does it exactly the way that I want for myself to search for winners every time. Okay, so as I said, you can select one of the three, Iron Condors, bull put spreads, or bear call spreads. You just select the button and pick that type of spread. And then the next thing that you can control is your days till expiration, or DTE. You can set it up so that it'll do whatever time frame you're looking for. If you like to do 0 DTE trades, you put 0 to 0. If you like to buy from 30 to 60 days out, looking to center in on 45 days, you can set up 30 to 60. Maybe you know the expiration that you want to target and it's 48 days away. You put in 48 to 48. So it's very straightforward. You have the screener or the scanner scanning all of the option spreads that meet your criteria within that time frame. Okay, so the next thing that you can look at here is the pricing type. So it depends on the time of day that it is. Sometimes I want to do natural, and sometimes I want to do mark, and sometimes I want to do last. And it's really a subtle difference. If it's aftermarket, the bid-ask spread just opens wide up, and you really might want to do last if you're just kind of scanning around trying to see what you might do tomorrow, because the last price might be what matters. The mark price can be great if the bid-ask spread is nice and tight, but if the bid-ask spread is too far, then you might want to use natural, because you're going to tend to pay the ask price, and you're going to tend to receive the bid price. So So the mark is the number that's right in the middle of those. And not often do you actually hit the mark when you do a credit spread. You usually have to give a little. So how much do you have to give? Well, that depends on the bid-ask spread. That depends on the difference between the natural and the mark. But in any case, you can decide which of the pricing that you want to use to scan. Okay, so the next item on the list is the probability of profit. So let's take a look at what probability of profit is again. We decided that if we were to sell an $80 put and buy a $78 put, we have some probability of profit. How likely are we to make money on this trade? Well, to calculate that, you have to look at the Black-Scholes formula or some other model. You have to look at this log normal distribution curve and complex math and figure out what your probability actually is. But I don't do that. The software, the screener that I wrote doesn't do that. But, maybe platforms like Thinkorswim do that, and I know Tastyworks does that, but we're going to use an approximation of this for our screener. So in that case, we get into the Greeks. And specifically for looking at probability of profit, we're going to look at delta. Now, when the underlying stock price goes up, the value of a call option goes up, and when the underlying stock price goes down, the value of a call option goes down. But it doesn't go on a 1-to-1 ratio. As a matter of fact, when the price moves up while it's way out of the money, we get small moves in the option. And when you're deep in the money and the stock goes up, we get big moves. And that's the delta. So when you're way out of the money, delta can be pretty close to zero. And when you're way deep in the money, the delta can be pretty close to 1. So we can say that when you're at the money, the delta is about 50%. So that if the stock moves up by $1 into the money, your option might be worth 50 cents more. But there's another way that you can use delta, and that is to say what is your probability of being in the money at the time of expiration. You see, if you have a $100 call and the stock price is $100, maybe you have a 50% probability of being in the money at the time of expiration. But if the stock price is if the stock price is 140 and you have a $100 call option, it is a pretty good chance, nearly 100% chance you're going to be in the money at the time of expiration. And if you're $40 out of the money, there's almost zero chance that you're going to be in the money at the time of expiration, at least for this example of being $20 or 20 days till expiration. So we can use the delta as an approximation of probability of profit. And this actually works pretty good. You can compare it to the TD Ameritrade and the Tastyworks to see how close this approximation is to the Black-Scholes that they build into their software. So anyway, let's take a look at that. We go back to our bull put spread. We have our $80 put that we have a 25 delta, and we have our $78 put with a $15 delta, and that works out that the center point that where it crosses the break-even line is a 20 delta. So that means that we have an 80% probability of profit. That means that there's only a 20% chance that this mark is going to be in the money at the time of expiration. So there's an 80% chance that it's going to be out of the money at the time of expiration. And as you know, when you sell a credit spread, you want it to expire out of the money. So we have an 80% probability of profit. And if we look at an Iron Condor, where you have that 20% delta on the left and you have a 20% delta on your call option, the combined probability of profit on that is 60%. So 60% probability of profit for this example, Iron Condor. So that's the way we calculate probability of profit. So what you can do is you can select the box in the scanner. Do you want probability of profit or probability of max profit, and what range is acceptable to you? Maybe you're looking for a 50% probability of profit. Maybe you're looking for 100% probability. Well, you can't get that. How about 90% probability of profit? You just plug in the number that works for you, and it will scan for those types of credit spreads. Now, the next thing that we care about here is our buying power effect and our profit and loss. The way I use buying power effect is for my money management. Say I have a $300 risk tolerance for an individual trade. Maybe I want to have 100 different trades running. Each one has a $300 risk. So what I can do is I can say that this trade will have a predefined buying power effect max. It won't show me any trades that have too much buying power for what I'm willing to risk on an individual trade. Another way you can do it is based on how much buying power you have in your account right now. Maybe you just sold something and you need to replace it. Maybe you just exited a position and now you have $500 in cash sitting in your account. You can change your buying power effect max to $500 and search for any trade that meets your criteria that's within your price budget. And your profit and loss minimum, what I found was that a lot of times these trades are too small. You can make $25 on an Iron Condor, or you can make $16 on an Iron Condor. And while the profit and loss ratio is great because your risk to reward works out in a nice balance, I find that commission becomes too high of a factor on the smaller trades. So if I can only make $8 and I have to pay $4 in commission to do the trade, well, commissions eat half of my profit. So the profit and loss ratio almost doesn't matter at that point because everything gets all out of whack. So in this case, I have it set right now so that I only look at credit spreads that will have at least $1 in profit, and that's per share. So that turns out to be $100. Maybe you want to look at things that have a minimum profit of $500. But what will happen is that your buying power effect and your minimum profit kind of have to be in balance, or else you won't find any that meet your criteria. And again, you have your profit and loss ratio that plays a role in all of this, and these all work together. So let's take a look at an example. We have our $80 put that we're selling, and we're collecting 85 cents, and we have our $78 put that we're buying, and we're collecting 35 cents. So that means that we receive 50 cents per share, and since it's 100 shares per contract, that's a $50 credit. So that means that our max profit is $50. And because there is a max loss, that's 100 times the spread minus the credit. And in this case, it's a $2 spread. 80 minus 78, $2 minus our $50 max profit means that our max loss on this spread is $150. And again, if we did the Iron Condor, we got 150 on the left and we got 150 on the right, each with a max loss potential of $150 and each with a max profit potential of $50. But since you collect both of those premiums with the Iron Condor, you make $100 max profit for your $150 max loss. Anyway, max profit, profit and loss ratio is your max profit over your max loss. I have it set to 33% by default. But again, this has to line up nicely with your probability of profit. If you're looking for a 75% probability of profit with a 80% profit and loss ratio, you're not going to find any spreads that meet that criteria. But if you're looking for something with, say, an 80% probability of profit and a 20% profit and loss minimum, then there might be some trades out there that will match that criteria. Okay, so the next item is show best only. What I find is that there'll be dozens and dozens, if not hundreds, of spreads that meet all of my criteria, but I don't want to see all of those. I really just want to look at the best ones. So I've checked this box right here that says show me only the best profit and loss ratios for each individual stock or ETF. And then the next item is balanced only. And this only counts for Iron Condors. I don't want any sideways Iron Condors. I like them to have the same spread on the left and the right, or I want my calls and my puts to have the same spreads. And I want the stock price to be pretty well centered, so that my delta on the left and my delta on the right are about the same. That's the way I like to do it. So I check this box right here that says balanced, and that's really helpful for finding Iron Condors that match my personal criteria. Okay, so the next item has to do with liquidity. We're looking for options that we can get in and out of really easily. That means that they have to have high liquidity. So depending on the day of the week or the time of day, I can set some of these options to look for options that have the liquidity that I need. So at a bare minimum, it has to have a bid and an ask. If you're aftermarket, sometimes there'll be no bid, sometimes there'll be no ask, and you'll get crazy numbers that just don't make any sense because there's just no bid ask on it. So I check this box to make sure that there's a market maker that's out there that's ready to do the trade. If you look at open interest, maybe you want to see that there's at least 100 contracts of open interest. You can just check this box and set it to 100, or you can set the volume. You can say that the minimum volume is 5,000 units and check this box. But the problem with volume is that that's on a daily basis. So if it's 9:30 in the morning, your volume might be 0 or 1. And if it's 4 o'clock in the afternoon, the volume might be 1,500. That's the volume for the day. So this changes throughout the day. So I don't use leg volume all that much. What's most important to me is the bid-ask spread. When I look at an option, if I'm going to build an Iron Condor out of 4 options, I want the bid-ask spread on each of those options to be nice and tight so I can get into it and out of it very easily. So most often I check this box and I set it to something like 10 cents for the bid-ask spread. That's the maximum bid-ask spread on every option in the spread that you're putting together. If there's 2 or 4 options in the spread that you're building, each of them has to meet that criteria. And then there's liquidity on the underlying stock. For instance, I might say that it has to have a minimum value of 1 million shares. And we can just check this box and it'll search for that criteria. And we can also check the price of the underlying stock, but I more do that with my lists that I'm using to search for. Okay, so let's move on here. Okay, so the next question is, how do we get this list of stocks that we're going to check for our credit spread screener? I like to import them from Tastyworks. So let me show you what I do here. I have a great big list. I have my watch list here, and this particular watch list is called Big List. And that watch list is just a giant watch list with like 1,500 different stocks and ETFs that I like. And you can put in futures and all kinds of things in here. It's up to you. And then what I'll do is I go over right here and I set filters. And I'll say something, for example, let's click trade. I'll go to the table and I'll see that in 32 days, there'll be the September 18th options in 32 days. So I'm going to go over here to filter and I'm going to say, don't show me anything that has a earnings report within the next 32 days. Okay. Also, I want my IV to be pretty high. I want my IV rank to be higher than normal. So maybe I say only show me things that have an IV rank of 25. And of course I want my liquidity to be very good. So I'll check the box to say only show me the 3-star and 4-star liquidity. And now my list of options got pretty short. Okay, so the next thing I'll do is come over here and click the CSV button. That allows me to export that list out and I can open it up in Excel. Once I've opened it in Excel, I can copy and paste those right into this area. Okay, so we'll just copy and paste that list right here. I think that was 108 items. I will set up my scan. We'll look for Iron Condors. We'll say DTE is, 32 days out and no less than 11 days. Again, I'm not recommending 11 to 32. You use the DTE that you like. But for this example, I'm going to set it up so it covers that September 18th expiration date. Okay, I'll set the pricing type to be mark. We're looking for an Iron Condor, so I'm going to look for a probability of profit of at least 60%. Because of my money management, I know that I want to put to work $350. I know that I need a minimum profit of, say, $85 for the contract. The profit and loss ratio, again, you can do multiple contracts. So So you just don't want the price of your commission to get too high relative to the price of each contract, or the profit from each contract. Anyway, my profit and loss ratio, we'll set it kind of low for an example so I can make sure I get some that come out. We'll set it 25%. I'm going to see only the best of the best for each of these tickers, whether they be stocks or ETFs. We're looking at Iron Condor, so I'm going to show only the balanced ones. Liquidity, I'm in aftermarket right now, so I don't want to set bid-ask spread because I know the bid-ask spread on these is going to be silly. I could use volume, but instead I'm going to use open interest and say that there's at least 100. Now let's just go with at least 50 for now. There's a minimum bid ask size of 1. That means that the market maker is out there and they're making bids. And I'll say the underlying price is $1. That's more or less controlled by my list anyway, so it doesn't matter. And I'm going to hit scan. While that's running, it's showing me that it's going to take 27 seconds or so. Now what I know is that the TD Ameritrade API will only let me do 120 calls per minute. So that means that if your ticker list is greater than 120 tickers, that it's going to be throttled. We're going to slow it down so that you don't exceed the limitations of the TD Ameritrade API. If it's a short list, we'll push them all through at the same time. But if it's a long list, we'll space them out 2 per second. And it's telling me now that it should be done anytime now. So here it is. Great. It popped open and it's recommending the Apple Iron Condor. Let's see, the trading price right now is $458 and it's recommending the expiration of September 4th. It wants me to do the put spread of 420, 425, and the call spread of 490, 495. And it's telling me that the credit I will receive, that's my max profit, and the credit received, $181. And my buying power effect, that's my max loss, is $319. And in this case, my probability of profit is just over 60%. And my profit loss ratio is almost 57%. And that's pretty good. I have a 60% chance of winning, a 40% chance of losing. And when I win, I make 57%. And when I lose, I lose 100 minus that. So that's a pretty good edge. You can see right here that I've calculated the edge to be 1.43. That means that that my profit and loss ratio is very strong considering my probability of profit. So what I'm looking for is a statistical edge where it's at least 1.0 or higher. So if we look at this other one over here, silver, the price is 25. It wants me to do this Iron Condor, and the credit that I'll make is 87, and my risk is 263, and that's a profit loss ratio of 33%. This is actually pretty strong. You're doing a probability of profit of 60% and a profit and loss ratio of 33%. I like it, but the edge is only 84. That means that it just doesn't quite live up to my expectations. So I'm looking for edge of 1.0 or higher. It's tough to find, especially manually. When I'm doing it manually, I take them like this all day long. Now, sometimes we'll see that the edge is way too high, and that's because the profit and loss ratio might come in at like $2,500 or 2,500%, something like that. And we know that's not real. We're in after hours, and in after hours, the bid-ask spread gets so wide, we just get artificially high numbers. So that's why for me, it's really important to run this at the beginning of the day when the market opens, or after lunch when I need to fill some trades. What I'll do is I'll turn on my computer for 5 minutes. I'll run the scanner. I'll find the plays that I want to do for the day. I'll place those orders. They'll fill. And maybe I don't check it until the end of the day. Maybe I check it after lunch to see if I have any positions that exited where I have cash laying around, and I'll put those to work. And because the scanner is so quick and easy, I can really find a position to get into with a mathematical edge in just a couple minutes. But the only caveat that I would say to this is I do manually check these. I am looking to see if the outlook matches my outlook. We're doing an Iron Condor here, and with an Iron Condor that has a neutral outlook. So if I'm going to take this Iron Condor credit spread, I better be neutral on Microsoft before I take that position. And what I want to see is that I think that there's support at 197, and I think that maybe there's resistance at 228. And if I believe that it's going to range in this zone over here, then I'm neutral on it, and I'll take the position at least between now and September 11th. If I don't think that it's going to range, if I think that it's going to go higher or lower, I don't think that there's the support and resistance to justify this position. Well, then even though it's got a great mathematical edge, it doesn't match my personal outlook for the underlying stock or ETF. So I won't do that. So let's take a look. Instead of being neutral, if we're bullish, I will come over here and click bull put spread. And let's say I want to see a probability of profit of at least 72% and a profit loss ratio of at least 20, and everything else stays the same, and I'll hit go. We'll watch it run. Okay, here we go, and here are the recommendations. We have gold, NEM, TQQQ, which I get into all the time, UAL, that's United Airlines, XBI, and what it's telling me is that I'm going to do a bull put spread, and it tells me to do a 176-180 spread on GLD, and that I'll make a $98 credit and a 302 risk with a probability of profit of about 73% and a profit loss ratio of 32.5, and my edge is 1.19, which is pretty darn good. So what I would do next is I would pop open the chart and see if I can justify this outlook by finding support and resistance, or whatever methodology you use to determine your outlook for an underlying. You would apply that and make sure that this position is good for you. You like the profit and loss ratio, you like the mathematical edge, but the outlook has to match your own personal outlook. Anyway, that's how you use the credit spread scanner. It's really easy. You just set it up, press go. In the next video, you'll see that I give you installation instructions that show you how to set this up on your own computer. Instead of paying $70 a month to Market Chameleon or something to barchart.com, you can set this up on your computer. It's absolutely free to download it. It's free to run it. If you have a TD Ameritrade account, it's free to get access to the real-time data through your own TD Ameritrade account. All you have to do is copy it to your web server and hit go, and I show you exactly how to do that in the next video. If you go down into the description of this video, there's links to that video showing you exactly how to install it. So good luck, have fun, and hopefully you find some great credit spreads. We'll see you later. If you want to see more videos in this series, make sure you click the like and subscribe buttons below.